Welcome to Lesson 3 of Week 13, focusing on internal controls. This lesson covers fraud prevention and separation of duties, the critical systems that protect grant funds and ensure compliance. Internal controls are not bureaucratic obstacles, they are essential protections. 2 CFR 200.303 requires that grant recipients establish and maintain effective internal controls over federal awards. These controls must provide reasonable assurance that you are managing the award in compliance with applicable requirements. Strong internal controls protect you in multiple ways. They prevent fraud by making it difficult for individuals to misuse funds. They prevent errors by creating checkpoints that catch mistakes. They demonstrate compliance to auditors and funders. They protect honest employees from unfounded suspicion. They protect your organization from financial loss and reputational damage. This lesson teaches you how to design internal control systems, implement separation of duties, prevent common fraud schemes, and maintain controls throughout your grant period. By the end, you will understand how to create control environments that support compliance while enabling efficient operations. Understanding what internal controls are helps you implement them effectively. Controls are systematic rather than random. Internal controls are processes designed to provide reasonable assurance that organizational objectives are achieved. The term reasonable assurance acknowledges that no control system is perfect. The goal is appropriate protection given costs and risks. Control objectives include safeguarding assets from unauthorized use or loss, ensuring compliance with laws and regulations, and maintaining accurate financial records. For grants, these objectives translate to protecting federal funds, following grant requirements, and producing accurate reports. Control components work together as a system. The control environment establishes the organizational tone. It includes integrity, ethical values, and management philosophy. Risk assessment identifies what could go wrong. Control activities are the specific procedures that address identified risks. Information and communication ensure people know their responsibilities. Monitoring verifies that controls work over time. Limitations acknowledge that controls reduce but cannot eliminate all risk. Determined fraudsters may find ways around controls. Unusual circumstances may not be anticipated. The goal is reasonable protection, not perfection. Cost-effective controls appropriate to your organization's size and complexity are more important than elaborate systems you cannot maintain. The control environment is the foundation on which specific controls rest. Without a supportive environment, individual controls will not work effectively. Tone at the top means leadership commitment to integrity and compliance. When leaders demonstrate that ethics and compliance matter, staff follow their lead. When leaders cut corners or prioritize results over compliance, staff receive permission to do the same. Leadership behavior shapes organizational behavior. Organizational culture is how people actually behave, not just what policies say. Policies on paper mean little if they are routinely ignored in practice. A culture where people follow procedures because they understand their importance is stronger than one where people follow procedures only when watched. Assess whether your culture supports or undermines controls. Competent standards ensure qualified people are in appropriate roles. People cannot follow procedures they do not understand. Hiring qualified staff and providing adequate training supports control effectiveness. Placing unqualified individuals in positions of trust creates unnecessary risk. Accountability means clear expectations and consequences. People must understand what is expected of them and know that performance matters. Accountability without enforcement is meaningless. When control violations have no consequences, controls become optional. Separation of duties is a fundamental internal control. It prevents any single individual from having too much control over grant resources. The core principle is that no single person should control an entire transaction cycle. If one person can initiate a purchase, approve the purchase, receive the goods, write the check, and reconcile the account, they can commit and conceal fraud without detection. Separation creates natural checkpoints. Key separations divide transaction functions among different people. The person requesting a purchase should differ from the person approving it. The person handling cash should differ from the person recording transactions. The person reconciling accounts should differ from those who initiated the transactions being reconciled. Each separation creates an independent check. Small organization challenges exist when limited staff makes full separation difficult. If you only have 3 people, achieving ideal separation may be impossible. Recognize this limitation rather than pretending it does not exist. Compensating controls are alternatives when full separation is impossible. If you cannot achieve ideal separation, implement other controls to mitigate risk. These might include more frequent management review, surprise audits, mandatory vacations that require others to perform duties, or external oversight. Document your compensating controls and explain why they adequately address the risks. Authorization controls ensure that transactions are properly approved before they occur. These controls prevent unauthorized expenditures. Approval limits establish dollar thresholds for different approval levels. A supervisor might approve purchases up to $1,000. A director might approve up to $10,000. Larger purchases might require executive approval. These limits should reflect both authority levels and risk tolerance. Written policies document authorization requirements clearly. Policies should specify who can approve what, under what circumstances, and with what documentation. Written policies create consistency and prevent confusion about who has authority. Ambiguous authorization creates opportunities for abuse. Evidence requirements define what constitutes valid approval: a signature, an email, a form. The policy should specify what documentation proves approval occurred. Electronic approvals should be as verifiable as physical signatures. Evidence must be retained to demonstrate proper authorization. Override procedures address how to handle legitimate exceptions. Sometimes urgent circumstances require deviation from normal procedures. Policies should specify how overrides work, who can authorize them, and what documentation is required. Uncontrolled overrides undermine the entire control system. Procurement controls ensure that grant funds are spent wisely on legitimate purchases. Federal grants have specific procurement requirements. Competition requirements specify when you must seek competitive bids. 2. CFR 200 requires competition above certain thresholds. The micro-purchase threshold, currently $10,000 as of November 2025, allows purchases without competition. The simplified acquisition threshold, currently $250,000, requires varying degrees of competition. Verify current thresholds as they may change. Sole source justifications document why competition was not used when you procure above thresholds without competition. Valid justifications include situations where only one vendor can provide the item or when public emergency exists. Justifications must be documented before the purchase, not after. Undocumented sole source purchases above thresholds can be disallowed. Conflict of interest policies identify and manage purchasing conflicts. Employees should not make purchasing decisions when they have personal interest in the vendor. Policies should require disclosure of potential conflicts and removal from decisions where conflicts exist. Undisclosed conflicts taint procurement integrity. Price reasonableness ensures fair value for purchases. Even when competition is not required, you should not overpay. Document that prices paid are reasonable. Compare to published price lists, recent similar purchases, or independent estimates. Cash controls protect liquid assets from theft or misuse. Strong cash controls are fundamental to financial integrity. Physical security protects cash and checks from theft. Cash and checks awaiting deposit should be stored securely with limited access. Blank check stock should be protected and inventoried. Physical security measures include safes, locked drawers, and access restrictions. Bank reconciliation provides independent verification of account balances. Someone not involved in cash handling should reconcile bank statements to accounting records monthly. This independent review catches errors and detects potential fraud. Unreconciled differences should be investigated promptly. Dual signatures require multiple approvals for large payments. Checks above certain amounts should require 2 signatures. This prevents any single individual from authorizing major disbursements unilaterally. Electronic payments should have equivalent dual approval controls. Timely deposits minimize cash holdings on site. Cash received should be deposited promptly rather than held. Holding cash creates theft opportunity and complicates record keeping. Establish expectations for deposit frequency, typically within a day or two of receipt. Payroll controls prevent fraud in this major expense category. Payroll fraud is common and can be substantial. Ghost employee fraud creates payments to people who do not actually work for your organization. Controls include matching payroll to personnel records, requiring supervisory approval for new employees, and periodic verification that all payees are legitimate current employees. Ghost employees are easier to create where controls are weak. Time verification confirms hours actually worked. Supervisors should approve timesheets confirming that reported hours are accurate. Where possible, compare reported time to independent evidence like building access logs or project records. Unverified time reporting enables inflation of hours worked. Rate authorization ensures pay rates are properly approved. Changes to salary rates should require documented authorization from appropriate officials. Unauthorized rate changes can siphon funds to favored individuals. New hires should have rate authorization before they begin work. Distribution controls verify that payments reach intended recipients. Direct deposits should go to accounts verified as belonging to the employee. Physical checks should be distributed by someone other than the person who prepared payroll. Misdirected payments can be difficult to recover. Understanding common fraud schemes helps you design controls to prevent them. These schemes occur across grant recipients of all sizes. Billing schemes involve fraudulent vendor invoices or inflated costs. Perpetrators might create fake vendors and submit invoices for goods never received. They might inflate legitimate invoices and pocket the difference. They might submit personal expenses as business purchases. Controls include verifying vendor legitimacy, requiring receiving confirmation, and reviewing unusual invoices. Payroll fraud includes ghost employees or inflated time reporting. As discussed earlier, ghost employees are fictitious people on the payroll. Time inflation exaggerates hours worked to increase pay. Both require supervisory collusion or control weakness to succeed. Misuse of funds spends grant money on unauthorized purposes. This might involve personal use of grant resources, charging unallowable costs to the grant, or using grant funds for activities outside the approved scope. Strong budget monitoring and transaction review catch misuse. Falsified records create documentation to conceal problems. When performance falls short or funds are misspent, perpetrators may create fake documentation to hide the truth. Controls should verify that documentation is authentic and that activities actually occurred as documented. Red flags and warning signs can indicate fraud in progress. Awareness of these indicators supports early detection. Lifestyle inconsistencies appear when employees live beyond their apparent means. Expensive cars, vacations, or purchases inconsistent with salary may indicate supplemental income from fraud. This is circumstantial and should prompt investigation rather than accusation, but it is a recognized fraud indicator. Control overrides involve frequent bypassing of normal procedures. When the same person repeatedly invokes emergency exceptions or management approval to skip controls, the pattern may indicate fraud rather than legitimate urgency. Examine whether overrides are genuinely necessary. Documentation gaps include missing or altered records. Fraud often requires concealing evidence. Missing invoices, altered documents, or unexplained gaps in records merit investigation. Documents that look different from others in the same series may have been fabricated. Resistance to oversight appears when individuals avoid review or refuse to take leave. Fraudsters often maintain personal control to prevent detection. Reluctance to share duties, resistance to audits, or unwillingness to take vacation that would require others to perform their duties can indicate problems. Control documentation demonstrates that controls exist and function. This documentation supports audit readiness. Written policies document procedures for all control areas. Policies should describe what controls exist, how they work, who is responsible for each, and how compliance is verified. Written policies create expectations and provide reference for questions. Training records provide evidence that staff understand controls. Training should cover applicable policies and the reasons behind them. Document who received training, when, and on what topics. Training records demonstrate organizational commitment to controls. Activity logs record control performance. When approvals are given, reconciliations completed, or reviews performed, document these activities. Activity logs demonstrate that controls are actually implemented, not just written in policy. Logs also enable monitoring of control frequency and timeliness. Exception documentation explains when and why controls were overridden. Legitimate exceptions occur, but they should be documented. Record what exception was made, why it was necessary, who authorized it, and what compensating measures were applied. Pattern analysis of exceptions can reveal control weaknesses or abuse. Monitoring and testing verify that controls work over time. Controls that are not monitored tend to deteriorate. Ongoing monitoring means regular management review of operations. Supervisors should be aware of how controls are functioning in their areas. Monthly reconciliations, transaction reviews, and supervisory oversight provide ongoing assurance that controls operate as intended. Problems should be identified and addressed in real time. Separate evaluations provide periodic independent assessments. Internal audit or external parties should periodically evaluate control effectiveness. These evaluations bring fresh perspective and may identify issues that ongoing monitoring misses. Findings from separate evaluations should be taken seriously. Corrective action addresses identified deficiencies. When monitoring or evaluation identifies control weaknesses, corrective action should follow. Document what was found, what action was taken, and how effectiveness was verified. Uncorrected control deficiencies invite problems. Continuous improvement means learning from problems and near misses. When control failures occur, analyze root causes. What allowed the problem to happen? How can controls be strengthened to prevent recurrence? Each incident is an opportunity to improve your control system. Fraud reporting mechanisms enable people to raise concerns about potential wrongdoing. These mechanisms support detection and deter fraud. Hotlines provide anonymous channels for reporting concerns. People who observe potential fraud need safe ways to report without fear of identification. Hotlines can be internal or external, phone-based or web-based. Anonymous reporting encourages people to come forward. Whistleblower protections ensure reporters are not retaliated against. People will not report if they fear losing their jobs or facing retaliation. Policies should clearly prohibit retaliation and provide remedies if it occurs. Federal law provides whistleblower protections for reporting fraud involving federal funds. Investigation procedures define how reports are handled. When concerns are raised, established procedures should guide response. Who investigates? How is confidentiality maintained? What happens if allegations are substantiated? Clear procedures ensure consistent and appropriate handling. Reporting obligations specify when you must report to funders or authorities. Grant recipients have obligations to report fraud, waste, and abuse. 2 CFR 200.113 requires disclosure of potential fraud affecting federal awards. Understand your reporting obligations and follow them when issues arise. Building a control culture makes compliance natural rather than forced. Culture supports controls more effectively than surveillance. Leadership modeling means leaders follow the rules they set. When leaders cut corners, staff receive implicit permission to do the same. When leaders demonstrate compliance and integrity, staff understand that these values matter. Leadership behavior is the most powerful cultural influence. Training and communication ensure everyone understands expectations. People cannot follow rules they do not know. Regular training, clear communication, and accessible policies enable compliance. Questions should be welcomed rather than discouraged. Positive reinforcement recognizes compliance and integrity. When people do the right thing, acknowledge it. Recognition does not require elaborate programs. A simple thank you for following procedures reinforces desired behavior. Positive reinforcement is more effective than punishment alone. Swift response addresses violations promptly and appropriately. When control violations occur, response should be quick, consistent, and proportionate. Delayed or inconsistent responses undermine control credibility. People need to see that rules have meaning and that violations have consequences. Let us summarize the key points from this lesson on internal controls. Internal controls are essential for protecting grant funds from fraud, error, and misuse. 2 CFR 200 requires that grant recipients establish and maintain effective internal controls. These controls are not optional bureaucracy, they are fundamental compliance requirements. Failure to maintain adequate controls can result in audit findings, questioned costs, and potential liability. Core elements of effective internal controls include separation of duties so no individual has excessive control, authorization procedures that ensure proper approval, documentation that creates audit trails, and monitoring that verifies controls work over time. These elements work together as a system. Weakness in one area can undermine the entire structure. Cultural foundation matters because controls work best in a culture of integrity. Policies and procedures are necessary but not sufficient. When organizational culture supports ethical behavior and compliance, controls reinforce natural inclinations. When culture tolerates corner cutting, even elaborate controls may fail. In our next lesson, we cover time and effort reporting, the critical compliance requirement for certifying staff salaries charged to grants. You will learn how effort certification works and how to avoid the serious consequences of false certification. Practice exercise. Evaluate your organization's internal controls using the framework from this lesson. Identify areas where separation of duties is inadequate, authorization is unclear, documentation is incomplete, or monitoring is insufficient. Develop recommendations for strengthening identified weaknesses.